Hello and welcome to this special show on the macroeconomic data that we are expecting. We are just getting the IIP numbers, which have come in at, I think, 5.9%, which is better than what the CNBC TV18 poll threw up. The important number is actually the CPI number. That's come in at 5.08. The CNBC poll said 4.9. We were prepared for 4.95. This is a tad higher than what the street was expecting. But I must say that the Reserve Bank was somewhat prepared for it. Remember, we had a chat with the governor yesterday, and he said the June inflation is expected to come around 5%. According to the wires, he said, but it's come a little north of 5 at 5.08. And I think the surprise has come, or the shock, if you please, has come from food prices, which has risen by 9.36%. The CNBC poll was 8.6, similar to the May number. The May number was also 8.6%, and it's come in at 8.69. So that's the one that's a bit of a surprise. We're still waiting for details. The website is just taking its time to get updated, but we'll be giving you the consumer price details in just a minute. Okay, cereals is up 0.7% month on month. The food price index on the month is up 3.2%. Like I told you, year on year, it is up year on year it is up 9.36%. So food inflation quite clearly the worrisome number. I'm still waiting for the vegetable inflation number, because that's the one that was expected to pull the entire food inflation higher. Well, I'm not very lucky with the website today, something going wrong with the net here, but I'll try and get you more. The pulses inflation is going to continue. Vegetable index up 14.2% on the month. I think the YOY number is going to be much worse. So vegetables have indeed been the reason why the food inflation number is worse than expected, and that is impacting the overall inflation as well, taking it higher to 9.36%, like I told you. The food and beverage index for the month is up 2.7%. Housing index is down 0.6% on the month. Last month, that is for May, the year-on-year number itself was just 2.5% for clothing and footwear. The fact for housing as well, the fact that it is down 0.6% on the month is going to indicate that core inflation is likely to remain very muted, probably below the 3% mark, at least going by the initial data that we are getting. Again, the fuel and light index is barely up 0.3% on the month. Again, that was an index which was low in May, staying around the 2.5% mark. It looks like an action replay of May, except for vegetable index, which was up 17% in May and is likely to be up even more for the month of June. That's, I think, the long and the short of it. As soon as I get the core index number, which is a calculated number, I'll keep you posted. But at the moment, it looks like inflation is a tad worse than expected. So even if Jerome Powell says he will not keep rates too high for too long, and even if the CME Fed Watch Index indicates an 85% vote for a cut in the US in September, it's possible that the Reserve Bank will vote differently. We shouldn't be expecting a cut anytime soon, certainly not in the August policy, or perhaps even in the October policy, considering that we have actually moved up from 4.75% in May to 5.08% in June. Next month is likely to be low because of a very high base. July of 2023, we got an inflation of 7.79%, and therefore year on year this number is likely to be lower. But the fact that the June number, even month on month, is higher is likely to keep the Reserve Bank on a cautious note. Of course, the ferocity of the stock market performance may also keep the Reserve Bank cautious. We'll have to wait and see. Let me get to our experts. We are joined by Aditi Nayar, the Chief Economist at ICRA. We will have more economists joining us. Okay, Nikhil Gupta, the Chief Economist at Motilal Oswal Financial Services, is with us, as is Devang Shah, the fixed income expert from Axis AMC. We will have, okay, Samir Narang of ICICI Bank is also with us. Aditi, to you first, 5.08, a little worse than you thought?
Good evening, Lata. Well, CPI is actually in line with what we were expecting. We did think that there was going to be a heat wave related jump in vegetable prices, which is what has come through. But the IIP has done a lot better than what we thought because of manufacturing.
Okay. Yes, I didn't say that the IIP number has come in at, I think, 5%, if I'm not mistaken. 5.9%. That's a very good number because we got an average more towards 5, and the manufacturing number has come in at 4.6%. So a very good manufacturing number, as Aditi just said. Samir, what do you make of this number? The CPI number more because that's the policy number, 5.08. Does that push back rate cut expectations?
Well, Lata, perhaps this could be the highest number you will see for the year, most likely, if there are no talks for the vegetable index.
Okay.
However, having said that, the RBI has clearly pointed out that they will look through the sub 4% interest number that you get in Q2, and after that it does inch back. So I think overall this doesn't change the narrative from RBI, which has been pushing the markets towards building a view that there is unlikely to be any major change in policy in the near term. So I think it gels very well with that narrative. And so we don't expect any which way anything in the next policy. My sense is that ideally you should expect a change in stance also later, perhaps closer to December than earlier today.
Okay. December. All right. Nikhil, your thoughts? Before that, Nikhil, if you don't mind, I'll just read out. Now we have the year-on-year numbers for the entire lot. Cereals and cereal products is 8.75% year-on-year. So that is going to be a spot of bother, not a big one though. The big problem is going to be vegetables, which is up 29.3%. I told you earlier it is 14% higher month on month. Year-on-year up 29.3%. Pulses is up 16% year-on-year. It was up 17% year-on-year in the month of May. Those are the three big offenders. Pulses, cereals and vegetables, mainly vegetables. The others is not much. Meat and fish, 5.3, egg, 3.99, milk and milk products, 3%, oils and fats is minus 2.7, fruits is plus 7.15, vegetables I told you, 29.3, pulses 16.07, sugar 5.8, again it's turning benign, spices also turning benign because the base is now high, is up only 2%, and prepared meals about 3.5%. Overall food and beverages up 8.36, clothing up 2.8, footwear up 2.05, housing up 2.6, and all of them are very benign. Fuel and light minus 3.7 year-on-year, that is. And then you have the services, miscellaneous services, household goods and services 2.39, health 4.1, transport 0.97, we saw that in fuel as well. Recreation and amusement 2.4, education 3.57, and personal care and effects, which I think is reflecting gold, that's up 8.2%. Otherwise, miscellaneous is all sub 3 and 4%. Nikhil Gupta, overall opinion on the CPI number?
Hi, Lata. So yes, the headline CPI is higher than what we were expecting. We were expecting close to 4.8%, and I just did some rough calculations. So most of the upside surprise is because of vegetables. We were expecting 25% or 10.5% month increase. It is closer to 14% as we mentioned. So yes, on CPI front, this is something that was very stable in the last 2-3 months at 4.7, 4.8%, 5.1% now. As far as the impact on rate cuts are concerned, we have always been maintaining that we are not going to see rate cut anytime soon. Irrespective of what the Fed does at this point in time, our growth is very strong, and even if it stays at 5%, inflation is not a worry at this point in time. If anything, this number postpones the rate cuts further, but again, it's only 1 month number, and we know that the next quarter headline inflation will come off significantly. So we are still maintaining that we don't see a rate cut at this point in time. In this
rate cut not in this calendar year, or you could expect it in the fiscal?
it may happen in February. February is still on the table and still a possibility. But again, we are not seeing a very high probability of a rate cut in this fiscal year as well.
Yeah, I guess February is very far away, as even the governor said yesterday when I spoke about FY26. Their dynamic stochastic model is giving a 4% inflation for FY26, and he said that is so many months away, we don't know. So I think February is really a premature question. Before I come to Devang, your thoughts, Aditi. The core inflation, by the way, it's a calculated number from Cogensis at 3.1, so it's unchanged from May. Your expectations from the Reserve Bank?
Data, if we look at what the problem is on the overall headline CPI inflation right now, it's very much the food pack. And on the food pack, we don't have a huge amount of comfort that is coming through as yet. The monsoon was very uneven through June, and even now I don't think, we have a huge amount of comfort coming in that the risks are out of the way. While the Kharif sowing is up substantially year on year, last year it was quite delayed. So this is coming on a low base, and we are flat to slightly lower if we compare to 2 years ago. So the month of July will be really quite critical in terms of, how things pan out for the Kharif crop. And also, do we end up seeing some sort of relief coming in on the vegetable price side even over the next few months? That is something we need to wait and watch. So as of now, we are not fully ruling out a December rate cut.
Okay.
I don't think that that's off the table. But there's a lot of, developments to take place between now and then to, even result in a stance change by October. So a lot of imponderables still out there for us to kind of get our hands on.
Okay. No, I take your point. If there is such a pressure from the US that it's not one but two cuts, and there was someone today arguing that, someone on the channel arguing that because the CPI number in the US is moved down because of average rents going down. The argument being until now incremental rents were going down, now the average rent has gone down, and that is normally sticky because the incremental rents work into the average, and therefore the argument is that we are going to see a sustained fall in US inflation. Of course, these are economists guessing. If that's the case and the global inflation is a different picture, maybe the Reserve Bank will change its mind, but at least as far as this data shows and as far as the governor's determination yesterday indicated, it's too premature to talk about rate cuts. But Devang, should we see a reaction in the markets tomorrow? Today the markets were reacting to the US yields, and we saw 6.97 on the 10-year. With this 5.08, any reaction?
So our assessment is probably we would not see any major reaction on Indian bond yields because of this CPI release. The markets need a new catalyst, and I think all eyes would be on the budget now. Our assessment is that probably if there is any kind of gross reduction in the borrowing or a tinkering of the fiscal deficit on the lower side, probably a 4.9 or a 5%, that would lead to further rally in bond market yields. Largely JP Morgan inclusion, CPI for this month and the next quarter, I think are largely in prices. So for bond markets to rally further, I think two perspectives. One, reduction in borrowing program. Secondly, I think I agree with the panel largely, Lata, that we are not expecting any significant rate cuts or stance change immediately. I think, in fact, as you rightly pointed out in your yesterday's discussion with the governor, that he's quite firm at this point of time. We don't need to ease the rates. But a peer pressure of central banks, specifically from Fed, if Fed starts cutting from September, we believe so that October policy is very much live for the stance change, and once the stance change happens, markets might start pricing in rate cuts. So that's how we look at bond market yields. Near-term catalyst is all eyes on budget.
Yeah, I take your point. I guess the governor also would have endorsed what you said, but I think on stance, the governor seems a little wary because it's a bit related to, well, he didn't use the word froth, I used the word froth. It is related to the euphoria in the stock market, and the feeling that the Reserve Bank has changed its stance can make the markets perhaps discount an early rate cut. So I don't know whether the stance also is all that live, But well, anyway, the governor has spoken for himself. I don't have to speak more. You have correctly interpreted, at least as I interpreted, that it's premature to think of rate cuts just now. But Devang, you put your finger on where we need to, the fiscal deficit. I'll come back to the panel on that. Let me just go through the IIP numbers very quickly. It looks like a stronger than expected number. For one thing, consumer non-durables, it was negative in the last in the month of April, has come in plus 2.3%. Consumer durables, which has been having a strong run, is up 12.3%. But the best performer, like it was in April as well, is the electricity sector, up 13.7%. That's the vertical which is contributing a lot, although it has only a 10% weight. Manufacturing, as Aditi pointed out, is the one that's contributing with a 4.6% rise, and therefore the IIP number really looks good. Nikhil, you want to add, does it increase your confidence in the growth story at all?
So actually, IIP number, it is in line with what we were expecting. We were expecting 6%, but I would not want to take any credit because we have been wrong so many times on IIP, so it would not be fair. Yeah. And like always, I mean, IIP is a very volatile number, not easy to predict. I would not read too much into IIP numbers. Okay. So growth steady remains as well.
Okay. I'll just read out the numbers for the benefit of you all to know. Infrastructure has done well, 6.9. It was a good number in May as well. Intermediate goods just 2.5%, capital goods just 2.5%. So both those numbers have been very middling at this point in time, but you can understand that as we went through election period, perhaps capex numbers were not picking up. Maybe they will later on. At the moment, I think the strong point has been electricity and consumer durables. Both of them have been doing well for a few months now, and they continue to do well, and they are giving that much strength to the manufacturing index as well. Well, so much on IIP. It's not a policy driving parameter. It's more CPI. So let me come to the point that Devang raised about fiscal deficit and get your views. Nikhil, what are you going with in terms of what the budget might tell us on fiscal deficit?
Lata, I would be very happy to see 5% or probably 4.9% as well.
No, we'll be happy, but how practical is it? Look at the rural inflation, 5.66. You think they will still go, or will they likely spend it on a larger PMAY, or I mean, what is your expectation rather than desire?
So my expectation is, I think 5% is almost a given, revised down from 5.1%. But again, given a choice, I would want it to be 4.9% because 4.5% next year is more challenging. And Lata, I just want to add one thing. Sure. India's growth is so strong. We all are talking about the economic momentum in the economy, 7% or more higher growth for the fourth consecutive year if we achieve it in FY25. I find it really surprising, and that we still need these kind of stimuluses from the government. Okay. And I think this is the time for the government to focus probably more seriously on fiscal deficit, because the next year and probably the next subsequent year, it would not be so easy to bring down deficit to the target. So 5% is what I'm expecting, but 4.9% is also.
That's a fair argument, but as we saw in the CLEMS data as well, labor productivity has been falling, even if employment is rising. So perhaps, there is an argument for the social security net. Perhaps there is an argument for, 100 units of free power, as many states are doing. But anyway, that's not on the central government's agenda. The idea of jobs which pay better wages could be on the central government's mind. We will have to wait and see. Your thoughts, Samir, what are you expecting? First, your any opinion if you have on IIP, and what are you expecting on from the budget?
So on the IIP front, I think you correctly pointed out, Lata, it's led by power sector. Given the heat wave conditions and the average temperatures in May, it was expected. We were also anticipating a sharp flip upwards led by electricity, but the overall number has surprised on the higher side. I think India should see a power capex cycle in the next few years on a sustained basis, and that will be a key driver of growth, ensuring a 7% or thereabouts growth continuing for the next few years. On the budget overall fiscal deficit, our view is that government perhaps will go with very similar numbers as to what it had predicted in the interim budget. Largely everything is continuing from a cabinet and the policy standpoint, so we do expect that kind of continuity in the budget as well. And we do agree with you what you're saying in terms of pushing somewhat of more of consumption, so there could be some changes on the income tax slab front. There could be more push towards consumption and slightly elevated expenditure on transfer to states for capex as well. So all of that put together, pretty much similar numbers in terms of fiscal deficit at 16.85 was what was in the interim budget, 16.8 or thereabouts. That takes it to at 5.1%. However, given the buoyant tax collections, if we do better than what is anticipated, then the government may show an RE or an actual number of 5%. But as of now, we believe 5.1 is what they will go with, given that there will be some reduction in the income tax collections if they do change the slabs. And RBI dividend will be judiciously used for more PMAY, more manufacturing PLI incentive, more incentive towards consumption.
So you're going with 5.1?
Yes, 5.1.
Okay. Aditi, what would you go with?
So Lata, as we spoke a couple of days back, we're also looking at 4.9 to 5%. And, broad numbers very similar to Nikhil's, but I'll just differ on one point. Yes, the headline growth numbers are really high, but there is a lot of unevenness in consumption. And I think that is sort of the justification for particularly supporting the rural economy that's already had a very unfavorable monsoon, and this one has also not started off that well. So that is something that is kind of a justification for why some specific pockets of the economy may need some help with stabilizing their consumption demand.
Okay.
On the, just very quickly on the IIP side, electricity has been very correlated with temperatures and with household and agri demand over the last few years.
Mm-hmm.
And already with the monsoon, picking up steam this month, we've seen the demand flattening down to a growth of 6% or so from the very high numbers that we saw in May. So it's not a bellwether anymore of what's happening in the rest of the industrial sector.
Okay.
And it's become extremely volatile.
Okay. No, I agree with you that extreme weather elicits extreme performance of that index, and it cannot be representative. But still, at 5.9, the IIP number is better than what the poll threw up for us, which was closer to 5%. And likewise, Kudensis poll also was around 5%. So it's clearly for the broad consensus of economists, it looks like a better than expected number. Thank you very much, Aditi and the gentlemen, for your views. The basic takeaway is that inflation is a tad higher than expectation, but no change to expectations of what the Reserve Bank will do, because both the governor has made it clear and the number indicating that we are not as close to the 4% mark. We will get closer next month because of a very high base, but as the Reserve Bank has indicated, they will wait because the inflation number is expected to jump back in the third quarter. So we are a distance away from any change in policy or stance. Certainly not happening in the upcoming policy. The IIP number, industrial output number for May, is a tad stronger than expected, largely on consumer durables and electricity. Growth strong, and therefore the expectation that fiscal deficit will not be watered down, so will not be increased. That is, the percentage may come down to about 5%. So all eyes are on the deficit and not so much on the CPI as far as the bond market is concerned. That's it from the macroeconomic data, but I have to give you a word on the big numbers that are flashing on your screen. HCL Tech beats all estimates in all parameters. It's an all-round beat, as you may be seeing, indicating the poll as well, whether it is rupee revenue or whether it is the EBIT margin performance. Expectation was that they would do some 16.9. They have done more than 17.1%, as you can see. See, these are lower on quarter terms, but they are all higher as far as the poll expectations were. And that's something similar to what we saw in TCS as well. So it does look like IT's slightly modest period is over, and the numbers are starting to look better than street expectations. So probably the period of lowering estimates, of downgrading estimates is over, as Reema Tendulkar said at the editors roundtable as well. The negative period is over. Whether we will start seeing huge upgrades and whether discretionary spend is not what TCS told us, we will have to wait to see what HCL Tech tells us. Maybe we have to wait till Monday to get their views. But the important point is it's a all ends up beat on estimates.